All right, here we go. Here's our credit unit section 2 notes. So right below the section 1 notes that you took, we'll just keep on moving with section 2. So we're talking about credit rating with the second section. We'll also talk about some credit cards and some different things with that. But this is your basic credit scores and what they mean. 349 is absolutely terrible. You have to just not be trying, basically, and never pay anybody back for anything, and you can't get any credit or anything. And all the way up to 849, 850, that is absolutely perfect. I've never actually seen a perfect credit score from anybody, but I've seen a lot of numbers between this 700 and I think the highest I've seen is like 833 before when running credit for potential tenants in rental property. A lot of people fall in this middle ground. They have failed to pay back some of the debts or some of the promises that they have, or they paid them back, but they just paid them back maybe not on time. So again, you want to pay everybody back on time in full to avoid paying extra or increasing interest rates and then extra fees and penalties. And you want to stay in this area is going to save you a lot of money over your life. This is going to be extremely painful and very, very expensive. And again, you're going to pay a lot more in interest, and paying interest is going to make somebody else rich in this category as well. Cash advance, that's a loan given in cash by a credit card. Basically, this is a very short-term loan. We're looking at 1 week to 4 weeks, somewhere in there, usually 1 to 2. Basically advancing a paycheck, more or less. And then a cosigner is someone who agrees to be responsible for a debt if the main applicant does not repay that. So an example of that, if let's say Coach Radke went to buy a motorcycle, they ran his credit ended up maybe in this area or this area, one of these two, and they said, you know what, Coach Radke, you just don't make enough money that we are confident that you're going to be able to pay this back on time in full. So if you get a cosigner with good credit, then possibly, then we could probably, make this thing happen. So Mr. Radke would come to Mr. Concilio and say, hey, Mr. Concilio, who's sitting over here with this credit score, and say, would you mind co-signing with me, and then I can buy this motorcycle? Well, here's the thing. If Coach Radke can't afford the motorcycle on his own, do I really want to be on the hook for his motorcycle if the bank or credit company or whoever decides that they don't want to be responsible for that? I don't want to be responsible for it either, right? So I'm going to tell you guys, hopefully this is very, very clear. Don't ever be a cosigner. It is a terrible, terrible, terrible idea. Never be a cosigner. Please don't be a cosigner. Because if somebody needs a cosigner, that means that they can't actually afford what they are trying to buy. If you are the cosigner, you will be on the hook if the original applicant, the main applicant, does not pay. And guess what? If the bank deems that they can't pay, then you should probably think that they can't pay either, and you don't want to be stuck with the bill if they don't pay. And if you say, oh, well, you know what, I'm not going to pay for that motorcycle either, so if Coach Radke doesn't make his payments on time, they come to me, right? That hurts his credit rating. Then they come to me and say, hey, you're the cosigner, you're supposed to be the responsible one, and then I don't pay. Guess what? That destroys my credit as well. Okay, so then I get penalized for something. I don't even get to drive the dang motorcycle, right? So never, ever, ever be a cosigner. There's only one situation where I would recommend being a cosigner, and that is if you are planning on making those payments yourself. If you're planning on making those payments anyway, then being a cosigner is not a big deal. I remember when I had like a year left in college and I was buying a car. My dad said that he would make the payments 9 months out of the year. I could make the payments the other 3 while I was working over the summer. And I didn't have a credit rating, so I was going to be, I had a very low credit rating because I just didn't have that much credit established. They were going to give me a very high interest rate, so my dad was a cosigner since he had an established credit rating. He was a cosigner for me, but he was planning on making those payments if I didn't make those payments, right? He would take the car away from me, but he was planning on making those payments. So that would be one instance that you could absolutely be a cosigner. I would never say be a cosigner for a friend. I've seen a lot of relationships damaged that way, especially family. Again, loaning money to family is just if you're going to loan money to family, just plan on never getting it back. And if you plan on never getting it back and that's not going to damage the relationship, then that's completely fine. Like, my brother wants to come over and borrow $1,000. I'm going to give him $1,000. And if he never pays me back, that's okay. Like, I'm not going to not talk to him because of $1,000. But if he comes over and borrows $100,000 and doesn't pay me back the $100,000, well, then we have a real serious family situation here, right? There's a big difference. Big difference. So again, if you're going to loan family money, make it an amount that it's okay if you never get the money back. I've seen a lot of family relationships, family dynamics ruined because of borrowed money and people just not being able to pay back. Same thing with a cosigner. Unless you're planning on making those payments, please do not be a cosigner. Debtors need cosigners because a bank has determined that they are not creditworthy. So if the bank says they're not creditworthy, guess what? A bank is better at underwriting, better at going and checking references and making sure their credit card bills were paid on time, their mortgage was paid on time, their car payments were paid on time, and any time that they borrowed money that they were paid on time in full. That's what underwriting is. And a bank does that. They have professional underwriters who determine if people are creditworthy or not. So if they deem that Coach Radke wasn't creditworthy for his motorcycle, guess what? He shouldn't be buying the motorcycle. It's just as easy as that. It'd be kind of funny to see Coach Radke riding a motorcycle. Can't see it. Is there ever a situation where it'd be okay to cosign? Yes, if you were planning on making those payments. Okay, when we're talking about credit cards, there is a grace period. So there's an amount of time allowed to repay the debt without having to pay interest charges. When you have a credit card, you start charging on the credit card. Let's say it starts on the 1st of the month, right? And the billing cycle finishes on the 30th of the month. So if you bought something on the 1st, you don't get billed for it until the 30th, and then that 30th, the billing cycle starts and a new billing cycle starts. One stops, the other starts, and then usually about 2 weeks after that billing cycle stops, that amount is due. So you could get a grace period of potentially like 45 days or so on your credit card, and a lot of small businesses will use that grace period to purchase inventory or purchase product, not have to pay it for 45 days, sell it to their customers who hopefully have to pay within 20 to 30 days, and they can get their cash flow, pay off their credit without having to borrow money or pay interest on it or late fees. So grace period can be a really great thing for some small businesses. Credit limit is the maximum amount a credit card issuer can charge on a credit card. Again, that is a max number. So if you have really bad credit, that number might be like $250 or $500. That's the maximum amount you can put on your card. If you have a really great credit score, that might be a $10,000 limit, a $50,000 limit. I don't know who would put $50,000 on their credit card. Somebody who spends a lot more money than the average person. That would be crazy. But yeah, and you can always raise those credit limits if you're paying your bills on time in full. Your credit score improves. You have this track record. All the time, credit card companies are calling me or mailing me things and saying, hey, would you like to increase your credit limit? No, my credit limit's fine. I don't need to put that much stuff on a credit card. But they're offering that to me because I pay my credit cards off on time in full. Two different types of rates. Anytime that we're borrowing money or talking about credit, a variable rate is an interest rate that fluctuates. So it changes. It can change month to month. It can change yearly. That's what credit cards have. Credit cards have variable rates. So when you guys are doing the activity today, you will see that there will probably be some sort of range or a variable rate, because credit card companies they can just change your interest rate for any reason at any time. Usually they're going to change it when you aren't making payments or you're making late payments. They're going to raise that rate. But even if you pay your bills on time in full, my Sam's Club card just called me last year and said, hey, we're raising it from 10% to 12%, just because they can. Okay, so that's a variable rate. I don't really care because I'm not paying the interest on it anyway. Fixed rate is an interest rate that always remains the same. Usually when you buy a car or a house on your mortgage, that's going to be a fixed rate. So on my home, it is a 3% interest rate. I got that loan in 2012, so I paid 3% in 2012. It's now 2018, and I still pay 3% on my mortgage. When I pay it off in 2024, here in about 6 years, it's still going to be 3%. Right? It's fixed all the way through. It's not going to fluctuate. There are adjustable rate mortgages. Those are referred to as ARMs. Usually those are going to be for short-term mortgages. So anybody looking to like flip a property or potentially live in a property for 2 to 4 years and maybe fix it up to sell it, you might work with an ARM or an adjustable rate mortgage. But if you're planning on living in the house, like I said, you should probably plan on living in that house for at least 7 to 10 years when you buy it. Then you want a fixed rate. You want a fixed rate because the economy, you don't know what's going to happen. The interest rates will change over time. Back in 2008, 2009, a lot of people had adjustable rate mortgages, and their payments, their home payments actually would double because the interest rate fluctuation. So a lot of people lost their houses because they couldn't afford to make their payments because their payments changed so much in a short amount of time. So borrowing money, anytime you're borrowing money, I shouldn't say anytime, but if you're borrowing money for usually some type of asset, right? That would be a collateral item. They're going to require a down payment of some amount of the purchase of that. So a lot of times for a house, if you want to avoid paying PMI, which is principal mortgage interest, principal mortgage insurance, you have to put 20% down on a home to avoid this extra fee. So if you bought a $200,000 house, you'd put down $40,000 as a down payment. So a down payment would go against the amount that you borrowed. So if you bought a $200,000 house, you put $40,000 as a down payment. You would borrow, or your principal amount on that would be $200,000 minus $40,000. That'd be $160,000. So the principal amount, the amount of money that is borrowed or still owed to a creditor, and that amount is $160,000, that's what the interest would be based off of. Okay, $200,000 house, $40,000 down payment, you borrow $160,000, and then interest is charged on that $160,000. Every month you make a payment. Part of that goes towards your principal to pay down your debt, pay down that $160,000, and part of it goes towards interest. That is the cost of borrowing money. Secured versus unsecured loans or debt. A secured loan is a loan that is backed by collateral. Your house is a secured loan. If you don't make your payments, the bank will come and take your house. Your house is the collateral. Unsecured loan, that is something that is more risky because there's not collateral attached to it. So this would be like cash advance loans, payday advance loans, credit card loans. You can go buy, you can go on a shopping spree with your credit card and go buy a 90-inch TV to hang in your basement. You don't pay your credit cards, they can't come back and take that 90-inch TV. That it doesn't work like that. That is unsecured debt. That is unsecured debt. So another type of secured loan would be a car payment. If you don't make your car payment, they're going to repo your car and take it back and destroy your credit rating. Signs of credit trouble, you guys can write 2 of these down, but I mean, these are very, very obvious. If you're getting calls from bill collectors, you're in serious credit trouble. If you're receiving past due notices, that means you haven't paid your bills or you don't have enough money to pay your bills. That's really bad. Your car's getting towed away by the repo man. That's a bad deal. Or you're just struggling to make your monthly payments, right? That's why we did that budgeting activity at the beginning. And it's the same thing for businesses. Businesses have to manage their cash flow. They have to manage how they use credit. They have to manage how much interest that they pay because the interest is going to take out or reduce the profit margins in the items. So it can really destroy or wreak havoc on your business as well. Plus, if you're not paying your vendors, as a business, if you're not paying your vendors, guess what? They're going to stop being your vendor, and then you can't even get product to sell to your customer. Factors that affect your credit score. Your business will have a credit score just like your personal individual have a credit score. A lot of times they're tied to each other, especially if you own your own business. 35% of that is just paying your bills on time in full, paying the gas bill, paying your cell phone bill, paying your credit card bills, paying your mortgage bill, paying those bills on time in full. Number 2 is outstanding debt, the amount of debt that you have outstanding. If somebody runs your credit and finds out that you have 7 different lines of credit that are open, you borrowed money on all of them, that's going to say that most of your future income is already accounted for and that you don't have any more money to pay any more debt. So that's a big deal too. Then, like we talked about before, when I was in college and my dad co-signed for me, I just didn't have a long enough credit history. So that was what was holding my credit score back. recent inquiries, if you go out and open a whole bunch of different credit cards or do a whole bunch of different things to what's called ding your credit, that can show up on your credit report. So if you go out to Royal Stadium and sign up for like 9 Royals credit cards because you wanted an umbrella, a towel, a t-shirt, a baseball, whatever, that's going to hurt your credit score. If you do it every so often, that it's really no big deal. And then the other 10% is types of credit in use. So that could be credit cards, mortgages, house payments, car payments, individual loans, line of credits with a bank, so on and so forth. Other notes, please, please, please do not be a cosigner. Never, ever, ever be a cosigner. Please don't be a cosigner. The only reason that you should ever be a cosigner is if you are planning on making those payments anyway. Just like my dad was planning on making my car payments, so he co-signed for me. But if you're not planning on making those payments, please do not be a co-signer. And don't loan any money to family that you're not all right with just losing, right? I'm not going to loan my brother $100,000 because I don't have $100,000 to lose. Fixed rate's usually better than an adjustable rate, so stick with a fixed rate, especially with your car loans and your home loans. And then credit worthiness, what the banks and credit unions look at when they are determining your credit score and if they're actually going to give you a loan, extend you credit, would be capacity, your ability to repay the loan, which means, do you have a job? Are you making enough money? Should you be buying this Lexus? And number 2, your character, whether you've proven that you have the willingness and ability to repay the loan. Okay, capacity and character. One does not necessarily connect with the other. Just because you make enough money doesn't mean that you are going to repay the loan, and just because you want to repay the loan doesn't mean that you can repay the loan. So ability and willingness to repay the loan. That's section 2. All right.